Hello everybody, I would like to tell you about our beauty salon, which name is ADAA. So our salon will open in 13th October and this salon was used by 4 people. Roughly saying, it is one of the affordable and with a wide range services beauty salon. We are waiting for you in our salon.
This is general journal for the first half. On the 1st October, each of owner invested 1 million tenge, and in total we have got 4 million tenge in our cash. On the 1st October, we purchased office equipment for the 550,000 tenge and office supplies on credit for the 1 million tenge. After on that day 15,000 tenge, we have got withdrawals, that is the owner's write himself a check. On the 3rd October, we get prepaid insurance for 540,000 tenge for the 1 year. On 5th October, to purchase repair of premises, we wasted 150,000 tenge, and on the 7th October, for the rent expense, we wasted 60,000 tenge. On the 9th October, we don't have any transactions. On the 17th October, to record the bill for the office supplies purchased in 2nd October, we have got account payable for 1,100 tenge. On the 18th October, we again have withdrawals that another owner withdrew cash for personal use. On 20th October, a client is extremely dissatisfied with their manicure hairstyle and demands their money back, so this is costed 1,800 tenge. After on 23rd October, we paid 20,000 tenge cash to repair equipment manicure machine that was damaged when moving it. On the 28th October, we paid for the utility expense 80,000 tenge to pay for the electricity, for the water, and so on, to record payment of October utility bill. On the 31st October, we paid to our employees their wages. Also on that day, to record services fees earned, we get 1,500,000 tenge in our cash. And also to record payment for October telephone bill, for the telephone expense, we wasted 2,000 tenge.
In creation, I would like to tell you about General Ledger. So first of all, it represents the record-keeping system for a company with a debit and credit accounts. So as you can see in our General Ledger, we bought office supplies, and debit side increased. But we took it into account that account payable credit side is increased. So what I would like to say, that we always need to be in balance in the general ledger. So as you can see in our general ledger, we are always looking for the balance.
After posting all journal entries to the journal ledger, we should summarize all these journal entries into their trial balance during the month. And there we have assets: cash, office supplies, prepaid insurance, office equipment that increases by debit. Then we have liabilities: accounts payable that increases by credit, but there we have 0. Then we have owner's equity: ADAA's capital that increases by credit, ADAA's withdrawal that increases by debit, service fees earned, sales revenue that increases by credit. Then we have expenses: wages expense, advertising expense, rent expense, utility expense, repair expense, telephone expense. And then the total of debit and credit should be equal to each other. After preparation of trial balance, the next step is to pass journal entries pertaining to adjustments. Then there we have some adjustment entries. The first adjustment entry: to adjust unused portion of office supplies. There we have 1 million tenge that we should subtract from 15,000 of unused portion to get 85,000 that we should debit and credit. Next adjustment entry: we should adjust expired portion of insurance. Since we bought insurance for 1 year, we should divide it to 12 and we get 1 month's insurance, 45,000 that we should also debit and credit. And the last adjustment entry is to adjust depreciation of office equipment for October. We have depreciation expense office equipment and accumulated depreciation equipment 9,000. After the adjusting entries are passed and posted to respective ledger accounts, the trial balance has to be corrected and adjusted to show the impact of the adjusting entries. And we have cash, office supplies, prepaid insurance, and office equipment that increased by debit. Then we have also accumulated depreciation of this equipment that increases by credit. Then we have liabilities, accounts payable that increases by credit. We have owner's equity account, others capital that increases by credit, others withdrawal that increases by debit, service fees earned, sales revenue that also increases by credit, have supplies expense, insurance expense, wages expense, advertising expense, rent expense, utility expense, repair expense, telephone expense, and also have depreciation expense, office equipment. Also, all of these expenses are increased by debit, and the total amount of debit should be equal to the total amount of credits.
Financial statements. There are classified income statement, statement of owner's equity, and classified balance sheet. To find classified income statement, you need revenues and operating expenses. Revenues. Net sales is our sales revenue and service revenue. Sales revenue equals 150,000 and service revenue equals 1,482,000. So our total revenue equals 1,632,000. Less cost of goods sold equals 0. And gross margin respectively equals to 1,632,000. So operating expenses is our selling expenses and general and administrative expenses. Selling expenses is our advertising expenses and it equals 40,000. General and administrative expenses is our supplies expense, insurance expense, wages expense, rent expense, utility expense, repair expense, telephone expense, and depreciation expense, office equipment. And it equals 1,344,000. Total operating expenses equals respectively 1,384,000. Income from operation is a gross margin minus total operating expenses and it equals 248,000. So net income respectively equals 248,000. Statement of others equity. Beginning others capital balance equals 4 million. Net income 248,000. Subtotal equals 4,248,000. Others withdrawals equal 65,000. So ending others capital balance equals 4,183,000. Classified balance sheet of others beauty salon. So assets. Current asset is cash, office supplies, prepaid insurance. Cash equals 3,132,000. Office supplies equals 50,000. Prepaid insurance equals 495,000. So total current assets equals 3,642,000. And property and equipment is our equipment less accumulated depreciation. Equipment equals 550,000. Less accumulated depreciation equals 9,000. So our total property and equipment respectively equals 541,000. Total assets equals 4,183,000. Liabilities. Current liabilities is accounts payable. It equals 0. Owner's equity is others capital. Others capital equals 4,183,000. So our total liabilities and owner's equity respectively equals to 4,183,000.
After preparation of the profit and loss account, income statement, balance sheet statement, and owner's equity statement, the accounts have to be closed to prepare for the next accounting period. And the first step, we should close the credit balances on the income statement accounts to the income summary account. There we have service fees earned, sales revenue, and the income summary is equal to 1,632,000. The next step, we should close the debit balances on the income statement accounts to the income summary account. We have income summary 1,384,000. And we have all expenses. The third step, we'll close the income summary account balance to the owner's capital account. We have 248,000. And the fourth step, we should close the withdrawals accounts balance to the owner's capital account. And then we have ADAA's capital. In order to find ending balance, we should beginning balance plus to the owner's capital account for October 31 and subtract it from withdrawals. And we have 4,183,000. And the last step, we should prepare post-closing trial balance. We have cash, office supplies. We have also prepaid insurance, office equipment, accumulated depreciation office equipment, accounts payable, ADAA's capital, and the total of debits is equal to the total of credits.
Liquidity and profitability. Liquidity. Working capital equals 3,642,000. Current ratio equals 0. Profitability. Profit margin equals 50%. Asset turnover equals 39%. Returns on assets equals 6%. Debt to equity ratio equals 0. And returns on equity equals 6%.